Trading range breakout. Now what we're going to do, we're going to talk about two different indicators that are also based on momentum. These are also sometimes used as trend indicators as well. They're a little bit different to what we've been looking at before, and these are breakout rules. So let's define first what is a breakout. A breakout is when the price is perhaps trading in a particular range and then it breaks out of that range, either going up or going down. Now, a common way to think about this is support and resistance, right? So the support is where there is considerable buying pressure, and the resistance is where there is considerable selling pressure, so prices normally will oscillate between that support and resistance. But sometimes it will break through that, right? So for example, if a price breaks through its resistance, then it's made a new high. If a price is breaking through its support, then it's made a new low. So this is actually a really simple rule. It's just support and resistance. It's just that it's now going to be in numerical form instead of graphical form. And the way we would use this from a trading perspective is that if the price were to break through its resistance, equivalently, if the price makes a new high over a certain number of days, then this is a buy signal. Okay, so we'd have a buy signal whenever the price is making a new high over a certain number of days. We'll say this is M days. And likewise, if the price were to break below and break through its support, then that would be a bearish sign. And we can characterize the rule by saying if the price were to make a new low over a certain period of days, let's say over M days, could be 10 days, 15 days, then this would be a sell signal. So it's a really simple rule, right? We look at the prices over the last, let's say 10 days, alright? If the current price is a new high out of that 10 days, then that's a buy signal. If the current price is a new low out of those 10 days, then it's a sell signal. If not, then there's no signal. And this is because we characterize new highs and lows to signal the breaking of the support or resistance, respectively. And that signals the continuation of a trend, or the start of a new one, if you will, right? So if the price breaks above its resistance, then that is the start of a new uptrend. If the price breaks below its support, then that is the start of a new downtrend. So this is a really common rule. We saw this when we did chart patterns and analysis. It's just that we looked at it from a graphical perspective, looking at support and resistance. Now we're going to think about the rule as trading range breakout, whereby the price has a particular trading range, all right, which is between that support and resistance. And when it's breaking out of that trading range, that's when we're taking a position. And we take a position in the direction of the breakout, right? So if the price breaks upwards, we take a long position. If the price breaks downwards, then we take a short position. Now we'll go into Excel and we'll see exactly what this looks like and how to do it. Trading range breakout. Alright, here we are back in Excel, and this is the relative strength index tab. So I'll go to the next TRB tab, which is trading range breakout. What we are going to do now is look at how to calculate the trading range breakout and how to determine the positions based on this trading range breakout. Alright, so what we're going to do is, if you remember the rule, it's that if the price makes a new high over a certain number of days, then that's a long position. If the price makes a new low over a certain number of days, that is a short position. And this is actually fairly simple to calculate, right? So I'm going to have my one column for my long position. I don't actually need to calculate any values here because it's just either long or short based on the prices. And I have a column for my short position. So let's just create that now. And how will this work? Well, so what I want to do is, let's say I'm going to set M equal to 10 days, right? So I'll look at the price over the last 10 days, and if it's a new high over the last 10 days, then that's a long position. If it's a new low over those 10 days, then it is a short position. Okay? So what we would do is that we would say if the max, that is the maximum of the last 10 days, so this will be B2 to B11, okay, is equal to this day itself. So if that day is the maximum, then I want long position. Otherwise, I'll have a 0. Alright, and you can see some long positions here. So whenever there's a 1, that indicates that that price was a new high for those 10 days, and it was breaking out of that range. So those are the long positions. And likewise, for a short position, it'll be very similar. I'll say that if well, let me just copy this formula across, actually. That'll be easier. So it becomes, we'll change this to B2 to B12. And it'll be -1 instead of +1. But instead of maximum, it'll be the minimum, right? So if the minimum of these is equal to the current price, then I want a short position. Otherwise, I want no position. So I'll calculate this. And then again, you can see there are some -1s here as well. So you can see instances where new lows have been made, just like instances where new highs have been made. And this is really how the trading breakout rule works. So it's really, really simple. Now we've calculated the positions based on these prices. And I just want to remind one thing to you is that we're actually calculating the positions based on current prices. So whatever positions we take here would apply to what would happen the next day, right? So if I had, say, the short position here, then the return would be based on what happened to the price the next day, right? Not the previous day, not this current day itself. So just want to keep that in mind so as not to arouse any confusion here. But that's just a side note. So we're not really going to be calculating the returns again, because again, this rule, the trading range breakout rule, is only an entry rule. Doesn't give us an exit rule or a stop loss, or telling us where to exit the trade, when to get out. It's only telling us where to enter. So we can't really go ahead and do a full trading strategy, but we can see that it's pretty simple to implement, right? And we could, for example, so here I've done 10 days. We could do it, let's say, over 20 days. Then it would be B2 to 22, right? And then I would just copy this all the way down. And then you would see there are much fewer positions, right? Because the price does make a new high over 20 days as often as it does over 10 days. Alright, so you can see again, it's fairly simple, and for short I do the same thing. So I'll just change this back to 10, because I think that 10 is probably a better rule because you get more positions out of it. If it's 20 days, usually that means you don't get a position very, very often, and it's not necessarily an effective rule. But of course, to find the best one, we have to play around with it. And when it comes to exit rules, there are a variety of different things we can do. We can have trailing stop losses. We can have rules that hold a position for a fixed number of days. Let's say we hold a position for the next 5 days, and that's it, right? So there are lots of ways we can play around with these rules. And so now we know what trading range breakout is. The next thing we'll discuss is the channel breakout, which is a variation on the trading range breakout, and a method to hopefully improve it, because there are a couple of shortcomings whenever we use this particular method. Channel breakout. The final rule and indicator we'll talk about in this lecture is called the channel breakout. The channel breakout is a very similar rule to the trading range breakout, as we just discussed, except that it adds an additional condition before making a trade. Now this condition may appear slightly complicated, so just try and follow along. Now, if you remember the condition for the trading range breakout, we had to make a new high over a certain number of days, or a new low over a certain number of days, and that would make us take a position. What we need for the channel breakout is that the ratio of the maximum to minimum price over the time period must be below a certain threshold, right? So let's say I have my 10 days, okay, and I'm looking for the new high. It needs to be the case that the ratio of that new high to the low within that 10 days is below a certain threshold, right? Below, say, 1 plus X%, maybe 5%, 10%, or 15%, etc. And we can kind of set this as we like. And once we have this additional condition, otherwise it's the same, right? So if we have a new high and this additional condition is satisfied, that is the ratio of the maximum is below this threshold, then we can take a position. However, if the ratio of the maximum to minimum is not below this threshold, then we don't take a position. Now let's try and motivate why this is the case. Well, when the ratio of the maximum to minimum is fairly small, that means volatility is quite low, right? Maximum and minimum are close together. If they're very far away, the max and min are very far from each other, then it's very volatile, right? And the purpose of this condition is to reduce the sensitivity to volatility. What we're saying is that if the price is extremely volatile, then we don't want to trade. That's what we're doing with this new rule. We're saying that it needs to be the case that the volatility is low enough that the new high actually represents a breakout. Because it's often the case that if volatility is very high, it may be that when we make a new high, it doesn't really signal a breakout. It's just part of the overall volatility in the price. So we want to make sure that the volatility is low enough such that the new high or the new low actually does represent a true breakout. So with the channel breakout, we'll take fewer positions as compared with the trading range breakout because we have this additional condition to satisfy. But the idea of it is to put us in a position where we're not trading when the price is extremely volatile, because we know that when it's more volatile, then there's a lot more additional risk. So it's not necessarily wise to trade when volatility is very high. So all this is doing is saying when volatility is very high, we're going to stay out of the market because we feel like there's less chance of us making money when it's very volatile. However, if the volatility is low enough, then we'll go ahead and place the trade. So let's now go back into Excel and we'll see exactly how this works. Channel breakout. Here we are back again in Excel. This will be the last time we go to Excel for this lecture. What we're going to do now is show you how to implement the channel breakout. So let's go over to the CB tab. The first thing I want to do is that I want to just do the same calculations that we did for the trading range breakout. If you remember, the channel breakout has two different conditions you need to satisfy. One is the new high over a certain number of days. And the other is whether the max over the min is within a certain percent. So let's first just do the new high. So I'm going to call this the long alert. So it won't necessarily be a long position, but it's when the first condition will be satisfied. Short alert. And this will just be the same formula that we used for the trading range breakout. I'll again use 10 days. So if the max of these 10 days is equal to the current price, then I want 1, otherwise I want a 0. Copy this all the way down. And likewise, I'll do this with the short, right? Except it becomes the minimum. And we have to just change BC to B. And 1 to -1. And now I have the short positions. Okay, now this is identical to what we had with the trading range breakout. If I go back to this tab, you'll see it's the same number, same formula that we used. The next step now is to add this channel condition. This channel condition looks at whether or not the maximum over the minimum is it greater or below a certain band. And if it's below that band or within that channel, then we want to take a position. So let's calculate the value of the channel. Alright, and the value of the channel is equal to the maximum over the 10 days divided by the minimum of those same 10 days. Alright, and you can see this is equal to 1.05. And I want to convert this into a percent, so I need to subtract 1. Alright, and then I'll multiply it by 100 to make it a percent. Alright, you don't have to do that. You can just makes it easier for me to visualize it. Sorry, let's get rid of this 100. We can actually just do the percent in Excel. So now we have the channel here. Now I want to create the long position and the short position knowing that we've satisfied the condition of the channel. So let's set our channel threshold to 7.5%. Okay? So we'll say that if the channel is below 7.5%, then we go ahead and take the position. If the channel is above 7.5%, then we don't take the position. The channel above 7.5% implies that the volatility is too high, and therefore we should not be taking a position. The channel under 7.5% indicates volatility is low enough that we can take the position. Now I've just picked 7.5% as a value. You can the right one to pick depends on how volatile the actual asset is. So we'll talk about that in trading systems. But for now, let's just go with 7.5%. So now I'll have long position and short position. And what I'm going to do here is say that, well, if this value is less than 7.5%, then give me whatever position is here. If it's greater than that, I just want 0, no position. Right? And now you can see, for example, in this case, when the channel was 7.6%, it gave me no position even though my alert said buy. Right? With the trading range breakout, we would buy here. With the channel breakout, we would have no position. However, in these two cases, the channel is below 7.5%, so our long position, our long alert turns into a long position. I'll do the same thing for the short, and it's going to be a very similar formula. So this is going to be if it'll be the channel, so it'll be if the if E2 is less than 7.5%, then give me D2, that's fine. Otherwise, give me 0. And again, now you see some minus ones here, but in these cases, because this channel is above 7.5%, we get no short position. So there you have it. This is how we calculate the short and long positions for a channel breakout. It's a few more steps than the trading range breakout, but hopefully this is a slightly better indicator that reduces our sensitivity to the volatility of the asset.